Good morning, everyone. This is what we're going to talk about. We at Voltec, we specialize in solutions for renewables and transmission, both on the equity and debt spaces. And it is in that context that we have seen this situation between renewables and mines. You can tell the girl in the middle at the point of maximum risk. One could argue that is the renewable sector. We know many markets where we have lots of projects who actually never get constructed. And it's a matter of life or death for the developers because they basically don't have a power offtake. Chile is a good example. We've heard a lot about Chile here today and yesterday. You'll find hundreds, if not thousands of megawatts there of projects that actually never get constructed. They're all ready to build, but they just don't get constructed because they don't get financing, and they don't get financing because they have no way to get their revenue stream stabilized. Or you can argue the goal there is the mining sector. Point of maximum risk, commodity prices down at the lowest for many, many years, and needing to cut costs, as we're hearing consistently across the board over the last 2 days. Well, you tell me, you can tell. The only thing I know, I don't know if that is the mining sector or if it's the renewable sector. The only thing I know is there's a gap in the middle. And the fact is that renewable projects are not talking to the same language as miners are. Why? Because the kind of PPA our answer to that question is that the kind of PPA they're offering is not what miners need. Miners don't need a stable price over time. They've made that mistake before. Many of them have, what we see when we talk to them is 10, 15 years ago, they thought they needed that. Now, in the current context, what they probably need is a power price that is linked in some way to the commodity they work. If it's copper, they would need probably a power price that's flexible and adapts to copper prices. If it's iron, it's gold, whatever, right? So our answer to that question is, why don't we develop a PPA where we can link the power price to the price of the commodity? That's what we're doing, and that's what we're introducing here today. We call it a synthetic PPA, a commodity-related PPA. In fact, what it is a flexible instrument. The big advantage of this is it's flexible for the mine, meaning if you're a copper mine and copper prices are up, you pay more for the power. In the simplest version of this, when copper prices are down, you pay less. So the power price is correlated to that of a commodity. Now, that means that the power generator is getting a variable cash flow from the mining offtaker. So how does that speak to bankability of that structure towards, getting the PV plant, the wind farm, whatever it is, even if it's conventional power, financed? What about bankability? How do you do that? Well, what we do is a derivative structure which is built in behind it, not entered into by the mine, but by the SPV, by the IPP, to turn that variable cash flow into a fixed cash flow. Intuitively, it's like an interest rate swap, right? You get a variable, you swap it for a fixed. That's what you get. And that is when it gets bankable. Because the cash flows, there's the third point there, the cash flows to the generator are predictable. That's what lenders want to see. So it's a win-win for everybody. Mine pays as prices move. The power generator has stable cash flow. Everybody wins. Now, intuitively it looks easy, but what this means is that you have to understand the mining business. That is why that gap was there, right? Most power generators from renewables are not looking into the miner's business. They don't understand it. We at Voltec have teamed up with Arnold van der Hoek, who's here. He's our advisor to that. He knows everything and anything about mines, more than we do, certainly. And he's our guy into understanding the mining business. He dives deep into the numbers, we discuss them intensively, and then we approach mines. When we understand their business, we understand their numbers going forward, what they expect, what the expectations, what the projections are, and we finally find that we actually start speaking the same language. We find them relieved. At least there's someone coming to me who speaks my language. That's an effort most power producers have not been doing, to be honest. It's all about the gap, right? Obviously, the tenor we can do that for depends on the term the commodity is traded for in the financial or in the trade markets, because of the derivative structure behind. So in terms of how long can we stabilize that cash flow for will depend on the commodity and on the term it is traded for. Minimum would be 10 years in order to get to bankability. No doubt there will be a merchant tail, but our perception is that most lenders in most markets going for 15-year post-COD money would be willing to take a 5-year merchant tail in their financings. Now, the key ratios we focus on are energy intensity and the energy intensity cost. We're going to discuss them a little later. The first one needs to show realistic values, energy intensity going forward over those 10 years. That's where we get into deep discussions with the miners and try to understand the differences, the different approaches they may take. The second one, the projected energy intensity cost, can be a little more tinkered and meddled with, if you wish. It can be sculpted. It doesn't need to show realistic values. These are the two. Energy intensity is known to everybody here. It's the energy required to produce 1 ton of output in terms of megawatt hours per ton. It's a ratio that's commonly used in the industry. The other one is a cost per ton sold in percentage. So how much do your power needs account for in terms of percentage over the price you get for every ton of output you sell? That second one is the one we can play with over the 10-year tenor. What these results in is obviously energy savings for the mine. It also means contracted revenues to the generator we were discussing, and ultimately bankability, which is the whole reason why those projects are never getting constructed. These are the tenors we could do depending on the underlying commodity. Copper is traded commonly over 7 to 8 years in financial markets. We could stretch it out to 10, equally for gold, around 10. Other metals go for, unfortunately, shorter tenors, so it would be a lot more difficult to put a debt package around any power supplier willing to finance the facility on the basis of this PPA. And soft commodities, yes, we have had soft commodities here. People inquiring, would you do this with sugar for a plant in Mauritius, for example? That's happened. That discussion's ongoing. Would go for 3 years. There's a whole spectrum of strategies when looking at these from the miner's perspective. Basically, from lower to higher risk, we have differentiated 3 structures we're going to discuss here briefly. The first one is for what we call intense savings in the short and medium term. This is a peg. This is a perfect peg. In the blue line, you see the power price. In the green line, you see the copper price. This is a correlation factor of 1.00. What that means is the power price follows the copper price perfectly over the 10 years. What this means is that what I said, commodity price goes up, you pay more for the power. Commodity price goes down, you pay less. No risk. You create the operating margin in your energy business as a miner, and that's what you get. There's no upside, there's no downside. Easy. Lowest risk. There's no exposure to the copper or iron or whatever the commodity is, price evolution. And what it entails is basically you have to take no view. This is probably least attractive in the current context. Why? Because I presume most of the people in the room would probably think that from the current price levels in commodities, 10 years from now, those people would be this bullish, those people would be this bullish, the people would be this bullish. But I don't think anyone here thinks that prices are going to stay that low for that period. So in the current context, you're probably willing to take certain risk that prices will move up from current levels. So I said, this much, this much, this much. I don't know, but most people would argue they're not going to stay there for the long term. So that's why we're proposing a second strategy. Well, this is what you see. Sorry, this is on the first one. The intensity cost starts at it's a growing factor, and these are the savings you would get. So if you would get the electricity cost as projected, the price you would have to pay with the synthetic PPA is around a 20 to 30% saving in the current market at current trading terms for the commodity. Now, as I said, this is a perfect peg, lowest risk. This is a second strategy, the one in the middle in the pyramid I was talking about first. This is moderate savings in the medium and long term. What that means is that instead of having an increasing energy intensity cost factor, as we had in the first one, this is flat. What that means is that you're taking a view that prices, commodity prices, are going to have a moderate increase from current levels over the next 10 years, or whatever the term is, 5 years, 3 years, whatever, right? So you're taking moderate risk on that, moderate exposure to price recovery, and you see the curve is different. You see your electricity price will go down over time, even if copper price in this case would recover significantly from current levels, particularly over the long term. So that means, in practice, the more copper prices grow, the less you pay for your power. So this is upside for the miner. This is not a perfect peg. This is the cost, the energy intensity cost. That's why we're calling it flat. And this is what it means in terms of prices. You see, they look the same, but they're not. They're actually divergent. This is 70 to 90 at the beginning, or 20-something. This is 30-something at the end. So they're diverging, right? It's not like you're locking in your operating margin. They're diverging curves, right? Higher risk, yeah. Moderate, probably assumable for most of the people informed in this sector with a clear view of where the commodity prices are going. The third strategy is what we've called maximum savings in the long term. Here we operate with decreasing energy intensity cost factors. That is the big difference between among the three of them, and that's the top of the pyramid. The plus for mines who have probably more riskier risk profile in their energy management policies. It represents a high exposure to price recovery of the respective commodity. What we have here is that power curves are most diverging. This is what we get in terms of the cost factor. Remember, the second one was flat. The first one was increasing here. What we've seen in the first one is that this line was increasing, the perfect leg. The second one, the moderate, was flat. This one is decreasing. You cannot hear me. Now? Is it better? What we had in the first one is that this line, in terms of the cost factor, was increasing for the first one. It was flat for the second one, and it's decreasing for the third one, right? This is the one we can play with. This is not energy intensity, which needed to be realistic. This one is someone we can tailor. We can tailor depending on your perception, on the miner's perception. And what it results in is this. This is in terms of prices. What it means is that the divergence between the two curves is maximum. So we start off with around 20, and we end up with around 40, 45 difference, which means you maximize your savings in the long term, meaning you stabilize your power price and you get a lot of upside, meaning that if the commodity price goes up, as you probably expect, the higher it gets, the less you pay for your power. That's it, basically. I was given 20 minutes. I thought you probably have a number of questions, so happy to answer whatever.
You're taking commodity risk, which is understandable, and that's fine, takes away from the mining company. But what do you do on the commodity going down to a level whereupon the mine was broke and no longer operates? Do you offset that with some sort of minimum capacity payment for the mine?
Not in principle. It would be taking full credit risk on the PPA, on the off-taker, right? If that we trust, I mean, the lenders to the power generator would have to trust that, you know, the miner counterparty knows the business and they will survive over the long term, medium term. I mean, it's not 20 years, it's not 30 years. Mine life is an issue, but that's why we go deep into the numbers and we trust that those managers are going to be doing a proper job. Same as we would be taking risk on the counterparties of the hedging, suite, combination of hedges that's, you know, underlying. The important point here is that the mine would not be taking exposure to the, well, we're taking limited exposure to the, but you're not entering into the hedges directly. We're not proposing the mine to enter into hedges. It would be the power generator who enters into those hedges, turning that variable cash flow into a fixed one for bankability purposes, right? But yes, but we're taking full credit risk on the off-taker, yes.
Okay, you've given a very interesting presentation.
Thank you.
Quite astonishing. My question will be, do you have right now any projects present in pipeline? And what's the perception of mines? What are you proposing today?
That's two questions. Okay. The first one is no. Okay. We don't know why no one has ever approached miners with this concept. That's why I chose the picture with a trapezist. There's a gap there. They're not speaking the same language. Why? We don't know. But when we approach them, as I said, they're actually relieved. Someone's speaking my language. Someone's gone deep into my numbers. Someone's willing to understand my business. Someone's willing to adapt the PPA proposal to what I need. That's a perception we are getting from most of them. Again, it's a good time and a bad time. You know that better than I do, because a lot of things are in flux now. Restructurings, cancellation of expansion plans, many things going on at every mine, right? But at the same time, it's a good time because now it's a time to talk about savings. talk about innovative ways of working on the cost side of a P&L. So we're getting a fair amount of traction with, if you manage to find the right people to talk to at the mine.
We're gonna go to break now, Manuel, but, yeah, you're around, or?
I'm all right.
Okay.
Thank you.
Okay.
Thank you, everybody.
Thanks.
Thanks.